You're watching Personal Finance with Coach Kelvin. Let's get into the video. Hey guys, Coach Kelvin here. Today I wanted to talk to you guys about why passive investing and active investing can be very different and yield different risks and rewards. So basically with passive investing, you're saying that you don't have the time or possibly the patience to sit down and research all of the stocks and all of the balance sheets and everything that it is you want to know about individual companies. And that's perfectly okay. For most people, passive investing is going to make the most sense. And in fact, legendary investor Warren Buffett also recommends that pretty much all investors should just invest in the S&P 500, which is the top 500 companies in the United States of America. Now, over the long term, you can expect about an 8% return every single year, and that's inclusive of dividends and capital growth. However, the last 10 years with the tech run that's happened in the United States, we've seen much higher returns. In the last 2 years that I've been investing in the United States, my returns are around about 18%, and that's including the whole dip for the pandemic last year. So I'm very excited to be a part owner in 500 of the biggest companies in the United States. However, there's other indexes or other markets you can invest in passively, which also yield good returns. So we have ETFs, which are low cost, broadly diversified, and include a large amount of companies or industries and sectors within it. So I personally own an Australian tracking ETF, an Australian market, a United States, and the rest of the world minus the United States. Now with this split or this balance, I get a very good worldwide exposure. It negates some of the risk of holding, say, a single sector or a single company. But on the other side of that, it also sort of negates any of the really big gains I could achieve from a single company. And this is why a lot of people argue that actually diversification can be worse for you than having a lot of eggs in one basket and watching it closely. So there's many successful investors that maybe own just a handful of companies, have high exposure and very high conviction for those companies, and yield amazing returns. For example, Berkshire Hathaway, owned by Warren Buffett and also managed by Charlie Munger, they invested in 2016 a large chunk of their wealth into Apple. Now, Apple has been on a huge growth run, still yielding double-digit returns every single year, and turned into this big $2.2 trillion company. Now, Berkshire Hathaway has over a 40% stake in Apple. Okay, so part of their of their own portfolio, that is, 40% or more is in Apple. The rest of their holdings are diversified, and they hold a lot more companies than just one, but they have a large exposure to a single company, meaning a lot of their returns are reliant on whatever Apple is achieving. Now, this has yielded a very good return so far, but that, of course, is an inherent risk later on, because if Apple, comes into some sort of trouble with the media, or they get in trouble with the SEC, or they perhaps have a really bad year of sales on iPhones and also software as a service, they're going to be restricted in how much value they can return to the shareholders or how many stock buybacks or dividends they can pay. And this is going to affect Warren Buffett's returns for that single holding. Obviously, they're very high conviction on Apple, hence they hold a large portion of it and will continue to. But I think it's very important to note that that's a sort of level of risk not everyone is willing to tolerate. You have some investors that can sit down, research heavily, even call up the CEO of a company or send emails back and forth with other investors finding out if their hypothesis is flawed, which is a smart move. But for a lot of investors, this may be too tedious and take up too much time. So simply buying an index fund and passively investing by, not worrying about whatever the media is doing and just adding your money in every single month using your dollar cost averaging strategy, you're going to yield better returns. Now, I was speaking to a friend who is also an active investor recently, and he actually, when researching a company, not only will he do his own analysis of that company, but then he'll ask someone to try and debunk his hypothesis, making sure that he hasn't missed anything. So after he's created a high conviction sort of hypothesis regarding whichever company he wants to invest in, he will then ask his friends and his peers, hey, can you look into this company and can you debunk any of the ideas that I believe are actually good? Like, is there anything you can find wrong with what I've decided? And I think this is a very healthy approach to have, because if you are looking for things that confirm your hypothesis, this is called confirmation bias, and you may actually turn a blind eye to any of the negative light that could be shone on that company if you're very much closed-minded in what it is you believe will happen. So having someone else who is impartial have a look at that company, maybe they have no affiliation to it, they've never heard of this company before, and they're going into it looking at it through, not some rose-colored lenses, they're going to be able to actually give you a different perspective, and that may help you decide whether it's still a good investment or whether you actually don't want to invest in that company. So I think it's a really strong and powerful tool to have someone else look over your work, if you know what I mean. So after that, he then will call up the CEO of a company, because in every investment statement, you can actually look at the contact details of the CEO. You can find the email, you can find the phone number, etc. And he told me he sat down and had a talk for over an hour and a half to the CEO of this company before making his investment. So that not only gives him exposure to the information that's readily available on the internet, but then also a chance to speak to the person directly who is sort of steering the ship. Now, when you have this sort of exposure and you can actually have the questions answered by the people involved, that's going to give you a little more clarity as well, because you're going to have the real analytical data or the real-time roadmap planned out to you by the people in charge, not by the people who are reporting it on social media or a podcast somewhere else in the world, etc. So I think this is a very active yet a very powerful approach to take. I, however, don't do this yet. My goal is to have a very solid base of ETFs and a broadly diversified portfolio before I start to branch out and make these more speculative buys, in my opinion. But just understand, this can be a very quick way to supercharge your net worth. If I'm getting an 8% return on my index funds, it's going to take me, about 7 years to 8 years to 10 years to double my money, depending on what that market's doing every year. Someone else buying a single company could double their money overnight or in 1 year. So that definitely speeds up the process. But understand, more risk yields more reward. So as fast as you could gain more, you could lose more, okay? So it's very important to also think about wealth preservation, especially as you get into higher net worth figures. What I like to think about is your investment portfolio should be a bit like a pyramid. Okay, so if you have a solid base, then as you build up your net worth, you can have these more speculative buys, but put less money into it. So if I have a big base of solid ETFs down here that yield very consistent and stable returns and fairly good dividends, that's going to set me up to funnel some money into some smaller investments all the way up until I build this pyramid, okay? So I think it's a really cool analogy to think of. Right at the top, you could have your very highly speculative and small portion of net worth investments. For example, it might be a dodgy cryptocurrency, or it might be just a small company that someone's told you about and you want to chuck 1% of your net worth in or something. But with these more risky investments, I think about having a smaller level of income or level of funds within it. So that's why my crypto portfolio is only 1 to 2% of my net worth, and my share portfolio is much larger because I want that to be my base, my base level of support. As I decide to branch out of just ETFs and buy individual companies later on, I'm going to have a solid base that sort of balances out any of that horrible risk that I'd be taking on. But that also will make me more confident in making a more speculative buy in the future if I wish to do so. Right now, I couldn't stomach putting, say, 50% of my net worth into a single company because, one, I'm not confident yet in my ability to analyze a company and then make a purchase into it without being able to factor in all the risks and buy without any bias. So I would utilize these strategies that my friend does, where he asks someone to debunk his hypothesis, calls up the CEO, sends emails around. However, right now, something I can do and that I am high conviction on is buying those ETFs that yield those returns I just spoke about. So this strategy works very well for me, And if legendary investor Warren Buffett can also recommend you to just buy the S&P 500 or a broadly diversified low-fee index fund, then I'm pretty confident that that's going to be a strong strategy for every single person, at least until you're ready to make bigger calls. By actually starting to invest in the first place, that's going to stop you overthinking things. It's going to get you some skin in the game and allow you to then actually understand what your money is doing, how it grows, how it moves in cycles. And basically, when you own, the whole broad market, you're going to have a chance to catch some of those big rises, and it's going to sort of balance out some of those falling companies, because as a company sort of crashes or fails, a new company will slip up into that index to take its place. I feel like this is a very safe way to invest. You can be very confident that over the long term, as more money is put into the economy and human endeavor takes over, so more business opportunities are created, the value of your portfolio will increase over time. This may not happen with a single company purchase. However, having a portfolio that sort of incorporates everything is going to work really well for you over the long term, if you wish to have an active portion to your portfolio as well as a passive portion. For myself right now, passive makes the most sense, but as I sort of shift out of that working 2 jobs phase and I can put more time into researching individual businesses, then I will absolutely make some purchases in that regard. It will give me more time to kind of hone on my technique of analyzing a business, and I'll also be able to really funnel my time into researching it over and over. So that's pretty exciting. So guys, I hope this gives you a bit of a insight into active versus passive investing. I'm not meaning to present you with any bias. I'm telling you what I prefer for myself and my strategy, which is passive investing into broadly diversified index funds. Like I said with my pyramid analogy, if you want to have other more speculative investments, put less money into the ones up here that have a smaller base. But if you have a strong base in your investment portfolio, that's going to kind of keep you afloat and stop you crumbling. Okay. Active investing can yield amazing returns for some people, and it will be the fastest way to double your net worth, but it can also be one of the quickest ways to halve it or worse. So guys, thanks for watching. If you got any value out of this video, please like, share, and subscribe, and I look forward to seeing you in the next video.